good.
We're good.
We're good, okay. So, I'm very happy this afternoon to have our two visitors. On my right is Marla Pump from STRS, and on my left is Gordon Gatnian from OPERS. I'm sure everyone knows OPERS and STRS are funded by the employer and the employee contributions, and they also count on investment income, if that's correct to say. So STRS, as way as introduction, I'd just say STRS has a portfolio for the pension of about $95 billion. OPERS is actually larger, maybe $106 billion. And each of these systems, STRS and OPERS, has their own healthcare plans. Healthcare, I thought it was healthcare portfolios, money dedicated to healthcare. Maybe they'll explain that it's not exactly that way. But they do have their own, of course, healthcare plans and make their own policies with regard to healthcare. So again, we're happy to have them here. And the idea was everyone can explore or ask questions. It's an opportunity to consider questions about the financial health of the systems, policy decisions and managerial decisions. I guess they're both open to about anything. And we're happy to have them here with us. So I'm not going to say anything else. Marla and Gordon said they're open to questions. And we have questions online. Marty is going to help us with that if there are questions online. So with that, we're open for questions.
My wife and I are both members of OPERS.
Thank you.
If we live long enough after retirement, that the amount that we are receiving in retirement exceeds contribution, does it end?
Give me,
Or do we continue to receive it forever until whatever?
let me see, should I repeat the question?
If you like.
So that everybody, okay, so what was, the question was,
The question is, do we reach a limit? I guess another way to put it, is to reach a limit of return on the investment and so forth that we contribute to for our retirement. If we achieve an age long enough that the retirement we're receiving exceeds what we contributed, does it end?
I think I can answer the question by,
yeah, the question was, is there an end to the benefit that you receive?
can you outlive your benefit, is
Yeah.
basically. And the answer is, if you're in the traditional plan, the defined benefit plan, the answer would be no. You are entitled to that benefit for as long as you live.
And the exception, would there be an exception for the 50% of the deceased?
If I understand your question correctly, the 50% for, that's the plan that you selected for the beneficiary, is that correct? Whatever that amount is calculated at the time of retirement, that's going to continue until the end.
So that's what we call perpetuity, is that right?
Perpetuity.
Yeah.
I will just chime in that the same is true for STRS. If you are receiving a benefit, you can't outlive your benefit from STRS in the defined benefit plan.
Dave, and then over here. Dave?
This will come to you, Marla. I think newspapers in Ohio are yelling about STRS's situation, and we're looking at a 92% loss, said the newspapers. In 2022, let me start that over again. Marla, this is coming to you, and I want to talk about STRS. Okay. And problems that are being printed in newspapers all around the state. STRS is apparently, or did lose in last year, 9.52% of funds. I want to know if that's anywhere near accurate in your eyes. 2, what do you see as the major issues facing STRS?
So with respect to the 9.52% loss, that was a calendar year reporting.
Okay.
So, and I make that distinction, calendar year versus a fiscal year, because STRS Ohio runs on a fiscal year basis like probably Ohio University operates.
Yeah.
So July 1 to June 30. So that 9.52 loss was accurate for calendar 2022. Now, the good thing, if you will, was that we're at halfway point of the fiscal year at that, and we've actually made some of that up. As I sit here right now, I unfortunately can't tell you what our fiscal year-to-date return has been. That's typically some information I get on Tuesday mornings from our chief investment officer. And I wasn't there for our senior staff meeting, so I didn't have the benefit of hearing Matt say what that was. But if I recall from last week, I want to say fiscal year to date is maybe right around maybe a little less than 5% fiscal year to date that we're up. So it's still not at the actuarial assumed rate of return of 7%, but clearly not a loss of, over 9%. So does that help with respect to the investment question?
Partly. I'm
Okay.
still looking for that second,
Sure.
the second part of the
Right.
question here.
So
is
what are
what
the
do you see are
challenges?
the major issues? I
What-
can tag on there and say, I saw the YouTube and I've read a lot that the analyst that was brought in, I think he's an analyst, is he an accountant analyst who looked through all of STRS's information, and they filed that with whomever in Columbus needs to be made aware of that. I don't have that with me, but can you enlighten us about that?
Sure. So if I understand correctly, let me say if I'm kind of guessing correctly, the YouTube video to which you are referring, I think it was the report that came out from Benchmark Financial Services, I believe is the name of the organization, it's almost 2 years ago. It'll be 2 years ago in May, if memory serves. And that was, to use kind of some contemporary vernacular, kind of crowdsourced, if you will, paid for by contributions. And so I think it's important to know that the assertions made in that report were almost to an assertion refuted in a subsequent audit by State Auditor Faber's office that was released in December. And they were, the auditor staff was very thorough, went pretty much point by point with what had been claimed in the Benchmark Financial Services report. I hesitate to call it an audit because the gentleman that conducted it's not an auditor, and he even made some disclaimers, if you will, statements in the report that it was not a forensic audit. So I didn't happen to bring it with me, but I can tell you without any hesitation that the assertions made in that report were refuted but through the findings of State Auditor Faber's office and the special audit that his office conducted. And that report was released at the end of December and can be found on the system's website if you're interested in accessing it.
All right, thank you so much.
Yeah, of course.
But there's a last question.
Yeah.
How would you summarize current state of STRS?
Current state of STRS, financially sound, Very sound, very, I think Dr. Rossiter and I were talking about this just right before we got started. So every year, the retirement systems are required to have an actuarial analysis performed. So it's kind of, we close the books on the fiscal year, and then pretty much as soon as, those books are closed, our actuaries start looking at, how we did, if you will. And last year, so our analysis is typically presented to the board in the fall, like October, November. And I can tell you right now, STRS's funding ratio is just under 80%. So we have 80 cents on the dollar for benefits owed. And then our funding period, and that's a concept that's maybe a little more complicated, but I'll try to explain it as best I can. So, and let me make this comment. So in statute, all 5 retirement systems are held to what's called a 30-year funding period. And effectively what that means is over the course of a rolling 30 years, you have to be able to pay down your unfunded accrued liabilities. So for us, that 20 cents on the dollar, you have to be able to pay that off over the next 30 years. And if you can't, so if you're over the 30-year mark, then you have to take a plan to the Ohio Retirement Study Council and tell ORSC how you're going to get under 30 years. Now, ORSC, real quick, is an oversight body. It's made up of 3 members of the House, 3 members of the Senate, and 3 gubernatorial appointees, and they have a professional staff of a director and 2 researchers. So, all of that to say that when STRS had the actuarial analysis performed last year, we're at 80% funded, and that funding period that's supposed to be under 30 years, we're at 11 and a half years. So that's the pension side of the house. They also look at our health care fund, and our health care fund is 230% funded. And so we, meeting all of our actuarial, what's the word that I want?
Assumptions.
Thank you, Gordon, thank you. Our actuarial assumptions, we have all the money on hand to pay healthcare benefits for that young person who just started out in the classroom, as well as, and we have retirees, 200 of them, who are over 100 years old. So we have funds on hand to pay healthcare benefits for all of those folks. So I hope that provides those of you who are in STRS a bit of comfort to know that.
Thank you.
Thank you.
Gordon, did you want to say anything about this? The easy way to think about it is this 80% ratio, which I read online from an actuarial association. They said it's not really a benchmark, but people like to refer to it as a benchmark. You should be 80%. So you want to, and again, we talk two different systems all the time, so.
I appreciate that. I was going to ask if I could jump in just to, since the question was asked of STRS, might as well address it with OPERS as well. We are currently at about 84% funded, which we're pleased about. We'd like to be 100% funded, and that's why we take a long-term approach to when we look ahead. We don't wait for the latest crisis to occur before we take action, much like STRS. We're looking broadly, Marla already said it, we're looking for those who start today and 10 years from now, as well as all of you who have had the benefits of retirement. I wanted to talk a little bit about the volatility. I think your question hit on this. because we don't look at, no, I shouldn't say that. No, let me back up. We do look at one-year returns because those are important, but we have to look at it in a broader perspective. We're looking 30, 40, 50 years down the road. So I wanted to give you some perspective on our returns. I know this was one of the questions that was posed in advance. So we looked back 50 years. We looked back from 1972 to 2022. OPRS has only had 11 years of negative returns in all of those 50 years. We've had 9 years where we've had positive returns, but not necessarily up to our assumed rate of return. Our assumed rate of return currently is 6.9%. It has been from, 1972 to 2016, it was at 8%. 2017, it was at 7.5%. A year later, we reduced it to 7.5%. Now we're at 6.9%. Here's the big kicker of this chart. We've had 31 years of the 50 years where we've had investment returns exceeding our assumed rate of return. So if you look at a chart, it's up and down, up and down, up and down, but the vast majority of that time, and I would suspect STRS would be in a similar boat where the returns have exceeded the assumptions that Marla talked about.
Yeah, I don't actually know that for sure, but I did, as Gordon was writing, just jot down 50-year look back because I want to find that information out.
So the second part of the funding metrics, I said we were 84% funded. Our amortization window, that window where we can pay down our debt, is at 16 years currently.
Hi, thanks for coming. My question is a general one to follow up kind of on the tenor of David's question. And that is, we've seen some events recently in the financial world that have stirred things up a bit. You plan on having a return of 7%. Now, that's a pretty good return for an investment. I don't know where I could put my money. I guess maybe you could find a broker who could do that. But what it means is investing in some high-risk investments. That's always the case with higher returns. And what you do is you balance that with safe investments. And I think every pension fund has treasuries and so on as a safety backup. And of course, the new story is that those treasury backups are not as safe as we thought they were, because essentially they failed Silicon Valley Bank, and they took a big loss on those. So what strikes me as an outsider, I'm sorry, my phone is going off. God damn.
Technology.
I apologize. I've been struggling with hearing aids and phones recently, and I'm losing. But in any case, I'm just interested in your perspective from the pension fund business about what this change means in terms of treasuries not being the same sort of security as we took them to be before this recent event involving Silicon Valley Bank. So that's my question.
Sure, go right ahead. Oh, for me. Oh, okay, sorry. Well, I think, therein lies the challenge, right? I mean, of markets that, and we're, as big institutional investors with, what combined between the two of us, almost $200 billion. So you sometimes are in some things that are a little more volatile than you otherwise maybe like to be. Yes, ma'am. But, sure. Oh, okay.
I was
sure.
thinking about you.
I mean, Yeah, I'd love to know what, yeah.
All right. Your Treasury securities are safe and will yield 100% of their value if you hold them to maturity. What we heard in the last week or so, however long it was, is that they had to be marked to market.
Right.
And so we had treasuries that were paying returns, paying coupons that were like less than 1%, and new returns are a good bit higher. And so that means that to sell those in the market right now, the value would drop. And that's what the problem was, and it always is. But if you have treasuries in your own personal security, they are safe. They will pay off at maturity at 100%. That's true. That's true. Absolutely. Okay.
He's going to reclaim his microphone.
Thank you.
Where do you want to address that?
Well, I certainly appreciate the investment
Yeah, thank
expert
you,
because
thank you.
neither one of us is an investment expert
Yeah,
up here.
right, exactly.
But I would go back to what I was trying to convey in talking about our historical returns. I know from an investment standpoint, you cannot look back and expect the same returns. However, again, I'm only looking at a 50-year snapshot, but we could even go beyond that. Times change, obviously. When was it in the 80s when you could just have a bond portfolio and you could be returning 8, 10, 13, 14%? Exactly,
Yeah,
exactly.
right.
So there does, our staffs, I think I can say this pretty confidently, they are highly trained investment experts. I'm not one of those, but we have consultants who work with the staff in concert to develop benchmarks and an asset allocation that is diversified in such a way that we can maintain liquidity and we can maximize our returns. That's a very fine balance that is very difficult to achieve. However, we have done that. We both have indicated we're over 80% funded. So again, I go back to that chart where I'm not going to sugarcoat it. 2022 was a bad year. It was a bad year. But I will share the story. I had a meeting with a state representative, and he asked me point blankly, what was our return for 2012? I told him. He said, oh, it's not as bad as I thought it would be. Keep in mind, here's another statistic that I'm going to throw at you. Just in the pension benefit alone, we pay out $583 million a month. So when people compare their personal portfolios to our portfolio, I ask the question, what percentage are you paying out every month? Ours is $583 million a month.
And yes, STRS is very similar number. Yeah. And if I may, just real quickly, because it's interesting, you know, if we want to talk specifically about Silicon Valley Bank, so STRS put out a couple statements because we specifically were in the news a fair bit. I think our investment there was a little bigger than OPERS. But yeah, and honestly, I mean, I had a couple legislators calling me because they had teachers calling them concerned about the welfare, if you will, of STRS and the ability to retire. And I think Gordon said it very well. I mean, if you kind of, you know, think about the system and maybe kind of relate it to your own portfolios or whatnot. I mean, Silicon Valley was a loss of 0.03% for STRS. So that's 3 cents out of $100, right? So you never want to lose.
Sure.
I mean, nobody ever wants to lose on an investment, but clearly that's not going to happen. So you want to guard
Yeah.
against it as much as possible, but not always
Yeah,
possible.
in the case of Silicon Valley Bank, they had something that you would never experience as a pension fund, because you can do these calculations of demographics in terms of age expectancies and these kinds of things. Silicon Valley Bank had a sudden withdrawal because of the problem that the local tech industries had in terms of paying their staff because their income had fallen. So big withdrawal from the bank, and that's when they had to cash in their treasuries, and why they took the loan on the market. If they had been able to hold them, as was pointed out, to maturation, they wouldn't have lost anything, but they had to. But you're not likely to be susceptible to that kind of shift that Silicon Valley Bank was taken by, basically, where there was a sudden withdrawal. You're not likely to have that. You can pretty much predict your withdrawals over time.
right,
So you should be in better shape to protect against anything like that than a bank, particularly a bank who is pretty specialized in a given industry.
Right,
Right.
yeah. Makes me think of, oh, shoot, now I'm going to blank on the Christmas movie with Jimmy Stewart and,
It's a Wonderful Life.
Yeah, Wonderful Life, the run on the bank. And every year when I watch that, I'm like, oh, thank goodness, people, that's not going to happen at Stars or Opers, but anyway.
Whenever any of us enlist a financial advisor, we always ask him or her, what is his fee, his or her fee? And it's usually a percentage of, or often, it's a percentage of assets. And so my question is, we know the returns from both pension funds. What is the investment cost that we don't know about?
So what are our fees? Gosh.
Your investment advisors?
Oh,
or-
per
Well,
advisor?
the total, you
Yeah.
know, of, because that's,
Gordon, I don't know if
that
you know that
reduces
off the
the
top of your
return.
I would
head.
have to look into my
Yeah, I would have
trustee
to look as well.
annual report. I can tell you, I don't know the number right offhand, but I can tell you when we report our fees, we report them net, we report our returns net of fees.
Okay.
So
That's-
it's not like we're reporting this figure, oh, but over here, you can't see the, no, this figure incorporates the fees.
Yeah.
So everything that you see from a return perspective is net of fees.
And the same is true for STRS, and I'm trying to find, I actually just looked this up the other day in our ACFR, and, oh, you know what? Bear with me one second.
Maybe I'll ask a question in there. When we're talking about the fees, am I correct to assume we're talking about the fees paid to some external advisors, not the people that are working?
Yeah.
And so that's, what, maybe 30% of the portfolio of STRS?
For STRS, right. So the external management, as Dr. Rossiter indicated, we have about 30% managed externally. I'm looking now at page 40 of our most recent ACFR, which I didn't bring our ACFR with me. I brought our SAFR, but this is available online, and I'd be more than happy to mail it to anybody that would like a copy. But for, let's see, for years, yeah, so our fiscal years in 2022, the external asset management fees was just about $255 million. And then about $250 million, a little bit more than that, the prior fiscal year. And yeah, does that help?
Somewhat. I need it in percentages, but that's okay. You know, that's fine. You know, for it to work in my head. All right, and then the other question that I really think everybody here is concerned about is our loss of cost of living increases.
Sure.
Because we're facing inflation that's going to continue, so.
Right, and
And-
so I think I think probably the best way to respond to that is that the board, and if you're interested, I mean, the board meetings are live streamed, and there's a link to that on the systems site. I think it goes up maybe a week prior to the meetings, and they're on the third Thursday of the month. So that link is available. But that is very much at the forefront of our board members' kind of, what they're thinking and their priorities, is getting to a place where, we can, do something that they're comfortable in doing something to as inflationary protection for the members. One of at our most recent board meeting, they talked about creating a menu, if you will, and that's probably my word, not how it was presented to the board. But here we go. So this is in our most recent board news, which I'm happy to leave this with Dr. Rossiter, and maybe she can make some copies, but it is available online, and perhaps as members you would have received it. But they are looking at a plan for sustainable benefit enhancements. But I will say, as part of that, one of the cautionary notes, if you will, and I forget if this was mentioned by the actuarial consultant, or it might have been staff, or a combination thereof, was, if say, for example, so Chiron, that's the board's actuarial consultant. If they come to the board and say, as a result of everything that happened in the last fiscal year, there's $3 billion here for you to take and do something with respect to benefit enhancements. So either, something with, for retirees, or maybe there's something that they would like to do for active members, reducing the service credit requirement. Who knows? I mean, all the cards are on the table, right? But the cautionary note was, we've kind of dealing with a situation where all of the money was spent decades and decades ago, and we're kind of dealing with, this, that having happened. So you might be well served to keep some in reserve. So just because you have it to spend doesn't necessarily mean it's a wise thing to spend it all. So does that help? And I'll leave this with you, Dr. Ross.
Yeah.
So just kind of as a follow-up to that, so does the board have a particular process they go through, or what they consider in deciding on whether to award a COLA? I know that they're trying to find or develop a more systemized approach, but maybe if you could walk us through that. What do they consider?
So here's the thing. I mean, I think this is such kind of, in some regards, relatively new territory for the board, because let's face it, for decades, it was the case that in statute, STRS Ohio retirees got a COLA. It wasn't always a prescribed amount. In fact, that was a relatively new phenomenon. So I think I mentioned at some point that I started with the system in 2001. It was only a couple years after I started that there was in statute an amount that the system, well, all five of us.
2003, if I'm not mistaken.
Right. And it was 3%. Prior to that, it had been this COLA bank that I couldn't even begin to describe, so we won't go there. But so the question, if the board has kind of a method of how they look at this, is I think, like I was saying, I mean, this is kind of new to them. I mean, so there was that 3% for a long time. Then we had pension reform in 2012. And so the legislature acted with, on a plan that had been presented to them by STRS, and they dropped the 3% to 2% and said there's also a waiting period, and that waiting period is 5 years. And then, so that's 2013, and then jump forward to 2017, and I'm really going to get in the weeds here, but it's important to understand we're all, and when I say we're all, I mean the 5 retirement systems are required to what's called a quinquennial. It's a statutory term that's been around for a really long time, but the way I describe it, it's a 5-year review, and it's an actuarial true-up. So how did the systems experience, how did it match the actuarial assumptions? And from that, what do we do going forward? And at the same time, so that's kind of on the actuarial side, but at the same time that that's being done, our board goes through an asset allocation process with their investment advisor. So in 2017, what came out of that experience review, that 5-year quinquennial, was the recommendation that we reduce our assumed rate of return on investments. So you assume you're not going to make as much, so that makes it more difficult on the system, and your liabilities grow. And then there was also recommendation that we adopt new mortality tables. I mentioned we have over 200 members who are over 100 years old. You and your colleagues in STRS live a long time. That's fantastic. That's great. But it's challenging, to pay benefits for a really long time sometimes. And so the COLA at that point, if any of you were retired, or were retired at that time, might remember that it was dropped to 0. And then the board made the decision after the most recent 5-year experience review, made the decision last spring to pay the 3% COLA. And so that's a really long-winded way of saying that I think it's going to be on a year-by-year basis, probably going forward for at least a while. And maybe they'll get to, this what are we calling it? Sustainable Benefit Enhancement Plan. And so I don't know if that answers the question. I hope it answers the question. But, like I said, I mean, for decades, it was the case that what STRS had to do with respect to paying the COLA was right there in front of them, and they said, okay, well, we have to pay this, so that's what we're doing. And now the board has authority around paying that COLA. Now, another thing that I have to mention here is that it is reviewed by the actuary. And I'll just put it in kind of my layman's terms. It has to be blessed by the actuary, and that is actually in statute. So, I'll just say, if the STRS board wants to pay a 5% COLA, Chiron has to come back and say, yes, Mr. and Mrs. board members, we think that won't be detrimental to the health of the fund, or no, Mr. and Mrs. board members, that really was not a good thing for STRS for you to pay a 5% COLA, so you have to look at something else. So.
Okay, and just for your information, where those numbers came from, 3% is the long-term average for inflation. It was calculated, and so that's where they got that. And then, I don't remember how many years ago, the Federal Reserve changed its goal for inflation down to 2%. And so that's where that came from.
Okay. All right.
Okay.
Thank you.
Just,
Getting a finance lesson here
I
today.
know.
I could have used it a really long time ago, but.
It's a much more easy question for me to answer because it's in statute and we follow the CPI. Or If you retired prior to 2013, you get a 3%. And I know it's flat, it's simple, it's not compounded, but very easy question for me to answer.
You're saying that Oprah is continuing, you're saying Oprah continues with COLAs?
We have to. We do not have the authority to set a COLA. It's in statute. It's required for those who retired post-2013. They get a COLA up to 3%. It's not to exceed 3%, but it's based on the Consumer Price Index. So anything between 0 and 3 you get. Anything below 0 is just 0.
So it's not discretionary, it's something.
Correct. It is not discretionary. Okay. That is correct. Well, not completely, because it is based on the Consumer Price Index, yes.
Okay, you ready for my question? Okay. I just want to know who manages your investments and how were they chosen and what kind of contract do you have? What kind of oversight?
Oh, gosh. So I feel like I've been going first. Okay.
Now, you said some of them are managed in-house, a certain
Right.
percent, and some
Right.
side. Okay.
Right.
And are they both the same for STRS and Oprah's? The in-house?
We are trending to more internally managed. We are, I think, at 56% internal management, but we are trending in that direction.
And for STRS?
So STRS manages, and I think this number holds true for quite some time now, roughly 70% of assets are managed in-house. And then the other 30 are with external managers.
And how were they chosen?
So we have, so I can speak probably best to the internal. Well, I mean, I'll come back to something I said just a couple minutes ago about the board going through an asset allocation process with their consultant, with their investment consultant. And that's a firm by the name of Callan. Excuse me. So they set the asset allocation. So whatever's going to go into fixed income, alternatives, domestic equities, international equities, bonds, real estate. I think I've hit pretty much everything other than, and so they decide that. And then, so we have teams that run the domestic portfolio. So there's probably about 80 or 90 associates that work directly on investments at STRS. And so we have analysts, we have portfolio managers, we have asset class managers, and then our chief investment officer. I can't sit here and tell you right now that if someone who's running a domestic portfolio wants to buy stock in Disney, that they have to run that past somebody. I mean, I think that they're given authority kind of commensurate with their abilities and kind of what's expected of them, right? So I think there are some limited circumstances, and this is probably true more of our international portfolios than domestic, where they have to run some things by people because of some, I will say, like agreement that we have with the legislature with respect to investments in Iran and Sudan. And so we're trying to stay out of companies that are operating in Iran and Sudan, but still sometimes it is the best, it might be, oh shoot, who's the big one? The German company. No, it's not Deutsche Bank. I can't remember who it is off the top of my head. But in any event, there are circumstances where people who are, some of my colleagues who are on the international side have to go to somebody and say, I want to buy a stock here. you know,
Well, let's speak about your external consultant thing.
Yeah.
You have a long-term contract with this firm?
with the external consultant.
Yes.
Actually, yes, and we are actually in the process, the board is in the process right now of looking to perhaps extend that contract, not sure yet, but an RFP was issued, I think, last fall for our investment consultants, both the general consultant and for the alternatives as well.
Yeah.
Yes.
Now, you essentially, I assume, operate under a corporate kind of operation, but where your clientele, all teachers, I'm speaking like of bonuses and so forth, okay? Your clientele probably is 99% have never received a bonus in their life, and they don't understand how you operate and give large bonuses. And there was this real problem probably about in 2008 where you lost 25 million and your people were giving large bonuses because they didn't lose quite as much as everybody else. I mean, it was really difficult for your clientele to understand this bonus culture.
Sure, and I can appreciate that. I think that couple things that I think are important to note. One, and I wish I'd mentioned this kind of just a second ago, but I guess it doesn't matter when I mention it because it's the fact of the matter. The system saves a lot of money by managing assets in-house. So we've saved about $134 million in fiscal 21 or 22 by utilizing the model that we do. And you can take that, I mean, you know, like I've said, I mean, that's the model that STRS has utilized for a very long time, is that a large percent of the assets are managed in-house. And you'll see that we've saved your money by doing that. You know, 134 most recently, 100, 110, you know, in some other prior recent years. The bonus structure, so I think that it's important to realize that we're the system are competing with Wall Street firms, with investment advisors, with, you know, the Callens of the world who are investment advisors, who that is, maybe not for Callen, but for other asset managers, that is the compensation structure. And it's also, I think, important to realize that that by paying or utilizing that payment structure where a part of the compensation is at risk, maintains, you know, my colleagues who are on the 5th floor managing the assets, keeps their goals aligned with the system goals. So you could, we could change models.
Your model, it doesn't have to be that way. I mean, I understand you're in the corporate situation and dealing with people in Wall Street all the time, and so we have a culture that's aligned with Wall Street. But at the same time, it doesn't have to be that way. First, I was thinking, I have a son-in-law who was director of parking at the University of Illinois. He was employed for a 3-year term. At the end of the term, they said, well, you're doing satisfactory. And so they gave him a $20,000 raise. Now, there was no bonus that he parked so many cars that he could, every year he'd get a bonus to this thing. And so it is true that the STRS board does not have to buy this wing. I understand it's a very dominant kind of model. But I don't think anybody's thinking outside the box and said, well, your clientele is not used to that model. Do we have to use that model? Why don't we pay these people a salary that's better than normal and then evaluate this thing and say, well, if you want to continue staying a salary better than normal, maybe we should go in.
I mean,
You could.
You could adopt it,
But-
well, the board could adopt a model of paying my colleagues. And let me be clear too, they are the only ones at STRS that get that are eligible for a performance-based incentive. No one else is, just the investment staff. So you could say, okay, well, we're gonna pay, these guys X amount instead of a PBI. But wouldn't you like them to have their goals aligned with the system's goals in terms of, if they're performing better, then there's a part of their compensation that's tied to their performance? And then I'll come back to the amount that's saved. $134 million most recently. So that's money that would have gone, presumably, to external managers. And so if we send it all out to Wall Street firms, those people are getting a bonus or a performance-based incentive. And I don't know that we would know what those numbers are. Here, you've got folks who are working directly for you, and you're being told every year, this is how they've performed, each of the asset classes, and the fund overall, and this is the amount of the performance-based incentive.
I quite realize I'm not going to change the system, and you're not going to change the system, but it is possible. But the big problem is, why is everybody so concerned, is the clientele does not operate under that system, and then everyone else is. I mean, they're at this level, and so there's really a lot of resentment. I think that there always will be.
I've been thinking about this,
Sure.
and I wanted to make a proposal to you or a suggestion. Among your clientele, you have universities with student portfolio managers. We have one here at OU, and I know because I started it. They're all over. There's a number of them in the state. These students are motivated to do well because they are learning. OU never used to send anybody to Wall Street, but we have since then, and they've done very well. We have a group that manages equities and another group that manages fixed income, and there's a small derivatives group. The foundation, the university foundation, allocates them a certain amount. So the equity group gets a certain amount allocated from the equity portion that's, from their, they have an asset allocation, and from the equity part, they give a certain amount of that to our students. And they don't actually handle the money. They don't ever touch the money. They have no access to it, but they do direct it. And there have been a number of years where they perform better than any of the professional managers. At the time I was here, our foundation had somewhere between 35 and 40 managers. And quite a few times, the students were had the top return. Now, the students don't take a whole lot don't need a whole lot of resources. They, they don't need those types of bonuses. They can be very happy with the fact that this is promoting their career, maybe a trip to your office to see the operations and to see how things are done, maybe helping to fund the trip to one of the, there's a conference, and I think it's in New York now, where they tend to go, and that would be a much smaller outlay, and it's our students, and so we would feel better knowing that they are helping to, to manage our money. It is a proposal. Please consider it.
And I would say thank you for the
Yeah.
proposal, and I would also suggest to you that those are the people that we want. We actively recruit from Ohio University, Ohio State University, and around well, it goes beyond Ohio, but those are the very people that we
But-
want.
But I'm suggesting that you employ these groups. Now, you have so many within the state, you can have a competition, and each year you choose the top 5 groups and have them allocate, let's say, your equity portfolio. You know, just think about it.
I would like to talk to you offline, because.
Okay, certainly.
Okay.
I want to follow up on this conversation that he began a little bit here, but I want to go to page 6 on this document and that
Safford?
lovely circle there and ask simple questions. This indicates, coming back to you, Marla, that 30% of funds are invested by outside managers. And we never really quite pin down who they are and how they get chosen. And okay, I can live with that for a little while. I want to know the following. You see where it says alternative investments?
Yes.
Now, this document's dated June 30th, 2022, for those that are online. Alternative investments, you had $18.3 billion, which is about a fifth of the whole portfolio.
Right.
What's an alternative investment?
What's an alternative investment?
Yes.
So
Don't
it's-
say real estate.
No, so it's, bear with me, we're getting a little bit out of my lane, so to speak.
Okay.
So private equity, I'm sorry? Derivatives. Yeah, yeah, but I don't, yeah, I mean, I don't think.
Venture capital?
Yeah, so all opportunistic, diversified, I mean, we're really getting into an area where I know I can't speak super intelligently to it, what all is in there. So Gordon mentioned hedge funds, which I'm not even sure that we have 2%.
We're out
Yeah,
completely, so.
yeah, I mean, I'm not sure that we have any money. in
Because you've
hedge
named a
funds.
number of equity positions and categories, I'm sorry. So I just wanted to know what alternative investments were. I mean, are we looking at cyber currencies? Are we looking at Bitcoin? Are we looking at collateral debt obligations?
I can't speak to page whatever,
Yeah.
because that's not my document, but I would suggest that, again, in the world of the investment arena, we're taking a look at all asset options, and with the help of consultants and our internal managers and so forth, that's how these are selected. We're not just picking something out because it sounds good. We are doing the due diligence. So again, I can't speak to the page that you referred to because that's an STRS document, but we're looking at the universe of options. And I don't know if that answers your question, but
And I'll just say, I mean, that's true of STRS as well, and that's actually it's a growing segment of our portfolio, and has been growing. And from what I understand from just kind of lay press, if you will, I mean that is, and you probably can speak to this much better than I can, but I mean it is a growing part of just kind of in the investment world in general, as bonds have not been able to, fixed income has not been able to produce the type of return that it once did, as Gordon kind of referenced earlier in the conversation. So we SRS, along with probably, many large institutional investors are looking for where that return is. And, I mean, I can tell you it's not in Beanie Babies, but I mean, we are looking at things that are viable options.
One of the questions about alternative investment follow-up is that they're not easily priced. And there's not a market value as there is for stocks or bonds that is readily calculated. Yet that does make up 20% of the portfolio for STRS. I don't know about Hopers. And as I recall, in the past, well, two questions. How frequently are prices updated? And the pricing mechanism for that, how does that relate? It seems to me that some of those returns were quite good over the past 2 years, while returns on stocks and bonds weren't.
Right.
It raises the question of what's the basis for that pricing of alternative investments?
So the pricing I can't speak to. I mean, that's really far out of my lane. But I can tell you, I mean, just in terms of returns on alternatives, that I'm trying to look to see if I have our more recent fiscal year returns. I don't.
Page 7.
In the SAFR? Yeah, so, does that, oh, yeah, right there. It shows that our alternatives kind of saved our bacon. Yeah, so, thank you for pointing that out. I sometimes get, you know.
That's the 1 year.
Right.
They, in the books, they look good over the 5-year period, but I'm not so sure if you had a 10-year return, if, you know, how it would be.
That
Those are
I'm.
unusual times.
Yeah, and to the extent that, you know, some of your questions that are fairly specific in an area that is, you know, like the pricing or the, you know, I don't have in front of me the 10-year return on alternatives. I mean,
Alternatives can be all sorts of things.
Right.
It could be Bitcoin, it could be gold, it could be derivatives, there's all sorts of things. And so when people sell stocks, they buy, or actually it's investment managers. Whenever they're selling out stocks and bonds, they've got to buy something. Sometimes it's just cash or treasuries, but often it's these. And so this is not something you use for a long-term investment. It's to save you in the short term,
which one?
the alternatives.
So,
And so for us, in a long-term portfolio, I personally think we have too much money in alternatives.
so I will.
Saved us on a 1-year basis.
Right, they performed very well in.
Long-term,
Right. So long-term, I actually can't speak to, but I also will kind of, they're not used as short-term investment vehicles. That's my understanding. I mean, that alternatives are often a place where, you know, that's a long-term commitment. In many instances, probably at least 10 years. You know, kind of by contract. And I don't know if you can shed additional light on that, Gordon, but.
Probably not. I guess my only comment to this discussion would be that I think the question was asked, I can't get into pricing either, but we continually review the asset allocations. The board is responsible ultimately for that final decision. Obviously, they're not going to make a decision without our investment staff's recommendations, but that's done at the very least on an annual basis. So whatever needs to be restructured will be restructured. But again, we can't turn a $110 billion enterprise around quickly. So we take an incremental approach, and when the asset allocation needs to be adjusted, we will do so, but not without much due diligence and thought.
Yeah, I know that Opers does have a portion of their investment in what they call a higher risk, but that's where you got your greatest return the last couple of years. I saw that in the annual report. So
That is correct.
it's a portion that you carved out just for that purpose.
It's good when it's good. When it's not, exactly, thank you.
Are we saying that an example of alternative investment would be a venture capital firm that's going with some high-tech startup? Isn't that some of what we're talking about
Yeah,
there?
that,
Yeah,
that
I mean,
could
that's
be.
part, or,
Yep.
yeah,
And
right.
sometimes that could be fantastic.
Yeah.
It could be the next Microsoft.
Right. But 2022 wasn't a good year for those people.
Are you then stating that the alternative, it needs a microphone, that those investments are high risk
They are higher risk,
than the others?
but again, it's risk and return, presumably.
Yeah.
The higher the risk, the potential for the higher return. It doesn't always work that way, right?
Because high risk actually means that there's more possibility of great returns and low returns.
Right.
It means that there's more volatility.
Volatility, yep.
Okay,
That's,
okay.
that's-
It just depending on your timing.
and do you want to speak to timing? Can't really time.
You put her on the spot. Yeah, I have a question. I read for STRS about negative cash flow, which, that surprised me. I thought that doesn't sound good. Maybe you want to speak to that? And I guess that goes to this idea of, or it's related to this idea of intergenerational equity, right?
Yeah, so negative cash flow is, just effectively means that we are paying out more than we are taking in terms of contributions. So we're paying out, STRS pays out a little over $7 billion a year in terms of benefits. We are taking in terms of contributions, less than half that. So that's the negative cash flow.
About 70% of your benefits, you OPERS folks, 70% of that is paid because of our investment returns.
Right.
We went from the well, go back to 1972, since I used that earlier. Go back, in that time, our active member to retiree ratio was 5 or 6 to 1. Any guesses where we are today? 1.2 to 1. So very soon, we're going to be 1 to 1. And then it will start going the other direction. But we're in this active member to retiree ratio is coming down to 1 to 1. That's why we are in a negative
Right.
cash flow.
Right.
Is that because they've offered the alternative retirement to everybody, that they don't have to be in, for instance, you don't have to be in STRS, you could be in the alternative.
Right.
Yeah, not
Yeah.
defined
Alternative
benefit.
retirement plan.
Yeah, I would say no, it's not because of alternative retirement, so the alternative retirement plan. So we were talking about this a little bit earlier before we all came in here. So for STRS, we've had the alternative retirement plan for a little over 20 years as an option at the, at the higher ed level, and roughly 40% of higher education faculty have chosen an ARP. I think it's just demographics. I mean, you've got a declining birth rate in the state of Ohio, and have had a declining birth rate in the state of Ohio for quite a while. So, you have you have less kids going into the schools, you need less teachers. We've had some other things that I would say are probably maybe cause some numbers to change a little bit at the margins. You've got vouchers and whatnot, but I don't think that's had a significant impact. Not yet. I would say the expansion of vouchers could have an impact. I mean, you allow, kids to, if the money follows the kid and it's going into local private parochial schools, then those teachers are presumably not going to be paying into STRS Ohio. But I think what we're, I think the current state, if you will, and STRS is more of like about a 1.1 to 1 ratio, so a little worse off than you guys, Gordon, is just, demographics and, lots of members coming through the system and not as many, out there paying in.
It's a cumulative effect for us. I mean, ARP would be a minor factor, but you put that on top of technology. I mean, fewer jobs needed.
Hopefully
The
not in
local
the
government
lotteries.
funds being reduced, so fewer jobs being recruited in. So again, cumulative effect, and it will change. It will go back the other direction. It just is going to take a while. 2034 is, I think, was what we projected.
We'll check if we have any questions from online. We haven't had very many questions about the healthcare funds, so I wonder if each system wanted to comment on the health of those funds, if they are in fact separate funds. And maybe I guess there's been more changes for healthcare recipients under OPRS than STRS. Maybe a
We've
little
had
bit
our
more
fair share,
controversial.
sure.
Okay.
Back in 2015, we transitioned to a connector model where we contracted with, at the time, Towers Watson. Now it's Via Benefits. I think it's still a subsidiary of Towers Watson. We now, for all of our retirees, because starting in 2022, we went to all retirees, are under this model where we have rid ourselves of the self-insured plan, so we're not providing health care, but what we are doing is providing a monthly allowance that goes into a notional account, and then every month, that pool of money is there for reimbursable, medical reimbursable expenses. It has worked. Those of you who are in it, you tell me, but seemingly the feedback that we have received has worked pretty well. We're in a closed model for Medicare eligible folks, so they have to register through Via Benefits and then go through the menu. Via Benefits assists our retirees through the process of selecting plans. They don't direct them into what plans they will select, but they will assist. For the the pre-Medicare population, that's an open market. So they will receive their, as long as they're eligible, there are minimum eligibility requirements. If you are eligible, you can receive this monthly allowance for reimbursable expenses. But for pre-Medicare, you can go out and get your medical insurance anywhere you want, as long as they're eligible expenses. So we have certainly simplified it, but the reason why we have done that is because the path that we were on with our healthcare fund, which is incidentally 115% solvent, so so we're in good shape there. But if we stayed on that path, because it was not predictable, we had, as you can imagine, we had fewer people in our plan, but the people who were on the higher end of the medical claims. So we have reduced our medical costs. I think I had that somewhere here. Pretty significantly. Well, I'll just tell you generally. We went from a few years ago, we were paying out $1.2 billion a year, and I think last year we were at the $850 million range. But it's predictable. People understand what they have in their accounts. We communicate through all means of communications. And in fact, we got to a point where the HRA, the health reimbursement allowance, those account balances in some cases were getting very high. So we went to the extreme case of communicating directly with those individuals, thinking maybe they didn't understand how those are to be used. And in many cases, they said, no, we understand. I have some surgery coming up, I'm beefing that up, and I will use it at that particular time. Seemingly going pretty well. That's where our healthcare is.
So for STRS, we are still managing, the self-insured plans. And I think I mentioned maybe earlier in my comments that we're at about 230% actuarially funded for healthcare. And I don't foresee any changes in terms of kind of moving to the model like PERS has moved to. For those of you who utilize the STRS coverage, I think, and it was all because of, underutilization, but it was nice to be able, I know it was nice for the board to be able to authorize the payment of those premium rebate checks over the last few years. So, but that's, I wanted to speak to something that Dr. Rossiter said. So the funds are, and we're a little different than OPERS on this too. So they are, I think it's right under $4 billion that's in our healthcare stabilization fund. Those assets are managed, kind of mingled in together, if you will, with the pension funds for investment purposes. Now, that having been said, I think that there have been, some suggestions over the last few years. Well, why don't you just close the healthcare fund and take those monies and put them toward, a COLA or something? We actually can't. I know it's been in the time since I've been at STRS, but it has federal code designation and qualifications as a separate trust. And so if it were the case that STRS, if the board said, we're done with the healthcare business, those monies would actually have to go back to the employers, because that's where the money from, other than premiums, but it had been the case for a long time that a portion of the employer contribution was allocated to the healthcare stabilization fund. And it was probably about 8 years ago, when the board said, we can't afford to put money into the healthcare stabilization fund anymore. So it all has to go on the pension side. And so, all of the monies that had been part of contributions to the system were actually employer contributions. So it is my understanding that, like I said, if STRS got out of the retiree healthcare business, that those monies would have to go back to the employers.
I'm glad you mentioned that, because I failed to mention that we do have two separate trust funds. We have the pension trust, which is mandatory. We also have the healthcare trust fund, which is discretionary, but as Marla already mentioned, we can't commingle that. And if in fact we pay down I think it's about $12 billion on the healthcare side, but that is funded solely by employer contributions, but we haven't actually paid into that since 2018. That's self-reliant on investment returns at the moment.
There are 16 people watching, but no questions.
Maybe go right.
Is that our
More
parking, Gordon?
technology.
Must be the market bell.
Oh, this has been wonderful, very informative. Tough questions. Any other questions?
So real quick, I think Oh, no, it's not on here. I thought maybe my contact information was on here. I guess it's not. I think Dr. Rossiter has it. I don't think, I know you do. So to the extent that you get home tonight and you're having dinner and you're like, oh darn, I really wish I'd have asked Marla Fuss and such, please know you're always welcome to call me or email me, and so Dr. Rossiter can get my contact information for you. And on some of those questions that I was like, what? Maybe we can follow up on some of those. So.
I agree. If you have questions, don't hesitate to contact Marla. I really appreciate you.
Yes.
I appreciate the invitation. Thank you.
Yes, thank you very much.
Thank you.